people have successfully made it as far away from Earth as possible. Is this because of how bad things have gotten here, Brett, or is this an achievement that we should be celebrating? No, I'll reframe this. It's great. We've got SpaceX secretly filing for an IPO. At the same time, you've got Artemis and NASA's program that is achieving something incredible, but at a enormous cost. How do you think about these two dynamics playing out with the private and public space now intertwining more than ever?
Well, this is a set of private launch providers providing the launch vehicle. It just happens that the launch vehicle that has carried these Artemis astronauts to the far side of the moon is composed of, I mean, ostensibly spare parts from the space shuttle program, but really it's almost like saying we're going to design a modern car, but one of the preconditions is we're going to base the engine like engineering and manufacturing on a Ford Pintos. And so I think that the expense is a function of the cost structure and kind of Congress going about this in a kind of cockamamie type way. It is evidence that, hey, we can do really ambitious things through government funding. And I think we'll be able to do much more ambitious things once we're on a modern engineering stack being deployed against that government funding. What do you think?
Yeah, well, I think there's a nuance that often gets lost, which is, okay, private sector doesn't waste money, and it's like NASA's just blown money, and that's bad. And so it's like the solution is private companies, but that is not true, right? It's like if the government just chooses to fund private companies and there's no mechanism for killing off bad progress, then it's like you still get a ton of waste. It's just via a different vector. And so I think it's like the key here is competition, right? It's like forget public, private, government, whatever. It's like having a healthy form of competition always leads to better end results here. And I think that's, what we're starting to see, right? When it was just SLS and, the SLS kind of formed as legacy baggage of various space programs. And it's like space programs, when we weren't going to the moon, were kind of just a jobs program because you've got, southern states that have all of these factories and you've got lobbying and you want to make sure everyone stays employed. And then you get these programs. But now I feel like there's an actual race happening on multiple fronts in space. You've got China, who's trying to set up a base on the moon. You've got the US that's trying to set up a base on, or human presence on the moon. You've got orbital data centers, which are another vector. And you've got a handful of players who are all going after this. And so I think this is the moment for, acceleration in space and much more capital efficiency because there's clear goals. And I think if people aren't meeting the criteria, you're no longer subject to just, one path here. You set out the competition.
But I'd expand it further where, as in, this system was clearly designed to meet a set of requirements set up by NASA in collaboration with Congress, I guess, to do a specific narrow task. Whereas SpaceX had like a huge ambitious goal, which is we're going to land, we're going to establish a colony on Mars. That still remains their north planet, I suppose. And in building up the technology stack to get to Mars, they unveiled all of this commercial opportunity that allows them to further capitalize and commercialize. And so Starlink arose because of the cost per launch that they were, bringing down to try to get to Mars. And so if you have commercialization vectors independent of government, that provides much better incentive structure for companies rather than government is going to actually pick your price to do a specific thing. And so now, like you say, with low Earth orbit satellite communications, there's clearly a big, $100+ billion commercial market that SpaceX is going after and others are going after. And then with orbital compute, there's a, at least order of magnitude, maybe more market that SpaceX and others are going after. The lifting craft and all the engineering they do to hit those opportunities then make some of the stuff that's less easily capitalizable, but NASA could point to, like, hey, we want to establish a moon base, or we want to establish a Mars colony, possible. And so that's where I think we're at. And this is a sign that at least, there's been positive press about this. Americans are still inspired by the fact that we're sending people to the other side of the moon. I think that means that there can be government funding for these types of operations.
It is incredible that they're so far away. But SpaceX reportedly confidentially filing for their IPO. What do you think is going to be the most surprising thing that, people latch onto in the filing? And then, simultaneously, before the filing's even out there, the most viral tweets I've seen going around have been, people just saying, oh, look, Amazon's revenue is this and their market cap is this. SpaceX's revenue is this, and they're going to come out at a similar valuation. Well, I feel like the way I was thinking of it is it's like, in a private market, it's like, what's your valuation? And then as soon as you become public,
Well, I
it's
guess,
like, what's
yeah.
your
So what I
market
have
cap?
been seeing, and I'm curious to understand from your lens, like how this can possibly make sense. You have roughly $20 billion in revenue expected or was posted in 2025 full year. They're growing at 25%. Obviously, they have the XAI acquisition, which I don't know where you want to land on that one. Massive dilution to SpaceX holders. They've lost a ton of ground relative to other chatbots. And then they're only growing 20 to 25%, or that's at least been reported. So coming at a 1.75 trillion or 1.5 or 2, wherever, the day decides the valuation might be. To me, I don't understand it. I would love an explanation of how you get there
I think,
mathematically.
sure. Yeah. The SpaceX's rate of growth right now is like, you can't look at revenue growth and be like, oh, that's the rate at which it can grow. That's a function of the up mass they can loft effectively. As in, they have leave aside AI compute for a second. They right now can deploy capital at a very high return on invested capital into Starlink satellites, because they are putting bandwidth up that people will use in all kinds of different ways. You're using it in your airplanes, you're using it on your houses, you'll be using it to get direct cell phone coverage. And so it's a great ROI opportunity, return on invested capital opportunity. And there is a constraint on how many satellites they can, profitably push up until they begin to use up that elasticity curve. And so I think in our modeling, Sam, it's between 100 and 200 billion dollars in revenue they could get off of that opportunity. It would be extraordinarily profitable for them, or we model it as being extraordinarily profitable, because they're the only game in town with the upmass to address it. Once they shift over to Starship, and assuming Starship is reusable, and a booster, their cost of launching that falls by an order of magnitude. So it becomes even more profitable, a set of actions they can take.
And the revenue growth accelerates. It's like lower cost, and your revenue growth accelerates.
Massively accelerates, because a single rocket can put 100 tons into orbit. And they only have on the order of like 20 Falcon 9s right now. They're designing for hundreds, if not thousands, of Starship stacks over time. So from the perspective of capital markets being, we're going to give capital to somebody who can then deploy that capital and get great ROIC, that's the way you should think about SpaceX. Now, the reason they're even coming public, because they could self-fund Starlink, is because to address AI compute, it's actually a much larger opportunity than that. It could be 60x more upmass required for AI compute. There's various ways you can go about calculating it. They've publicly announced, hey, we need 1 million, it's 1 million satellites, right, for AI compute that they filed for, whereas they'd only filed for on the order of
Yeah.
40,000 for Starlink. So, that's 20x bigger in terms of number of satellites out there. So they are going to take the capital and they're going to deploy it against that opportunity. As a shareholder, you should think about, well, given this capital invested in this thing, what am I going to get back? That doesn't necessarily relate to the revenue on the capital base that they have right now. In fact, they could be totally independent of each other. You could be, I have like a license to mint money. I just need to take money from you and then it produces, whatever the return is. I think that's the way to think about the company. So to say, hey, here is now, like, I don't disagree with you, Nick. I think that people in the market will look at this and be like, this is insane. It's X times whatever current revenue is. And that's effectively a narrative value between people who, believe that businesses should only be based upon the cash flow that they're generating today versus businesses that should be valued based upon the cash flow they're going to deliver to shareholders having deployed capital.
Well, I guess,
against that
for me,
opportunity.
it's more on a relative valuation basis. When you start to look at price to sales multiple, if you were to say that this comes out at 2 trillion, which he's come out and denied, but that's just a much easier rounding number for us to say, okay, it's trading at 100 times sales, growing at 25%, versus you look at Meta doing they're valued at 1.4 trillion, doing $200 billion, growing at 33%. And all of these companies at the Mag 6 level, Mag 7 level, have a license to print money and have demonstrated significant ROIC, especially given the AI opportunity that's like right in front of them.
No, but they have a
It's
license to print money. Yes, they're printing money right now, but at the margin, they are buying back shares, paying out dividends. They don't have a place to profitably
right.
put
There's
Well,
money.
no
no, you could
catalyst.
say
It's like
that wasn't true
imagine if
4 or 5
Amazon.
years ago, but now with AI, they do, right? Like they compile this into data
Oh,
centers and turn
and I
this
think that's
into a
money well
massive
spent.
AI story, which most of them are at least Google and Amazon are starting to do, right? From a data center build out. Meta obviously needs to internalize that, turn it into advertising profits, maybe build out their own Meta AI capabilities. But they all have a similar structure in the way that they can obtain these massive opportunities. So, like, to me,
Mhm.
it's just on a relative basis. Like, if you are saying, hey, you can deploy $100 into the market, I don't know why you go throwing it at something trading at 100 times. Like, yeah, I don't know. I think it's a great company, by the way. Like,
Well, the good thing.
oh, I don't like everything you're saying. I fully agree with. I just don't
But
understand
do
why
you
you would pay
understand
up.
do you understand the distinction I'm making? As in, imagine I sell you a business where it's like a car wash and it generates, I don't know, $100 a year. You're like, it's going to keep generating $100 a year. That's fine. Versus I say, hey, I have like this new car washing technology, and I just need to build the car washes, and then they'll generate $400 a year. But there's some upfront capital I need
But
to
on
do
a
that.
relative,
And
but
that's
again,
the kind of whole
if I have to
go-to-market motion
pay
here.
$1,600 for the $400 a year, then it's a bit of a different story, right? Like this is, part of the modeling here is what it comes out at drastically changes the longer term opportunity because you're pricing it all in upfront at the IPO or a lot of it for the next few years. You have to really
Well,
grow into the
we would
valuation.
argue you're not. I think the rate at which companies can grow is going to. I think this is going to be the big surprise for people who choose to stay on the sideline, right? It's like if you look at Nvidia's revenue growth over 3 years, you would have said that's impossible, right? And it's like that's because there was demand. It's like people didn't even know there was demand for these chips, and then there was, and they built it and grew that business. Here, it's like we know there is demand for this, or we're fairly confident. It seems clear because people are trying to get it in other ways that are less efficient, and that's connectivity. And so it's like you can build into this opportunity that already
Sure.
exists.
Nvidia trades at like 20 times sales.
No, yes. And I think that again, it's a question of, the market. rewind the clock back to the kind of maybe early 20th century. It's like equity issues used to just be priced on dividends paid out. That was it. It was basically like, what is the dividend? And that's what I'm going to pay. Because why would you pay for a business that's not generating cash flow back to you? And then they realized, well, actually, there's some businesses that they shouldn't be paying out the dividend because they should be investing in future infrastructure that will raise the net present value of the overall business. And the way in which the businesses were priced changed over time. It used to be you paid for book value only, and kind of like book value would generate some dividend yield. Then in value investors for a long time were like, why would we pay anything above book? That's a crazy thing. Why would you pay anything above book value? And as it turns out, book value ignores a lot of intangible assets. There's all kinds of problems with it. With SpaceX in particular, it's going to be a question of, can they make a reusable rocket? If so, what is the return they're going to get on the capital that they invest in that business? And how long will they be able to basically spin this circle of taking cash, reinvesting in more satellites, taking cash, reinvesting in more satellites before somebody catches up? And the difference between SpaceX and every other opportunity you could put out there is there's nobody else within a decade.
That's what you should have led with
in terms of their ability to loft things to launch.
Well, I do think this is the biggest point. Yeah. That is one of the biggest points. It's like, very concretely, there's no company in the world that has as big a lead on their competition than SpaceX. And it's like, the way that you can just very simply put it is, they've got a rocket that they're reusing with high efficiency that they've been doing so for like the past 11 years. Blue Origin is the first other company that just landed an orbital rocket, but they have yet to reuse it. And then the question is, what's the rate of change on improvement? And it's like, I think it's fair to say SpaceX is continuing to accelerate. And so their lead is only growing.
I think that's the answer, right? Because a lot of people are going to say exactly what I've said, which is, wow, it's trading at a crazy multiple. I don't know how you make sense of it. And the answer is, well, no one else can do what they're doing, or they can, but it will take them 10 years to get to scale. So it gives them a massive runway, and the opportunity in space is infinite because space is infinite. So we can go mining for asteroids and gold and go to the diamond planet and do all kinds of fun stuff. And that's the real opportunity, which is fine to say because I think you can justify a higher multiple than others if you have a significant moat or something you demonstrated high ROIC or can continue to demonstrate that out into the future. I think that's totally a fair point to that's a fair counterpoint to this multiple is outlandish, because a lot of people are going to say it as soon as the public gets win. As soon as the S1 drops, people are going to see right now everything is rumors, but as soon as people see it, that's going to be the first point.
I also think there's the cost of capital thing, which I think is underappreciated, which is, let's say there was another company that was executing as quickly and as effectively as SpaceX is, which they're not. SpaceX's cost of capital and the cost of capital throughout their investment cycle to get to where they are now is so much lower than everyone else's, where it's like, even if you took a company and you said, you are going to be as good as SpaceX was, and we're going to set you on that path, and they had to raise the capital, they wouldn't be competitive.
What do you think of their...
You don't think so, Brett?
Well, it's just a dissatisfying point because
it's true. It's like
they're yes, being able to raise as much as they're planning to raise at the valuation that they're planning to raise it at, means for shareholders, you are getting a lot of capital that they get to deploy. That's not, that expensive on a relative basis. And I think that the Nick's, Nick, we just won you over to our side. I'll take the other side for a second, which is there's other kind of not just the value per revenue of the company as it floats, but can they turn their compute resource advantage into an actual monetization advantage on the AI side is an open question that is yet to be proved out. And how long does the demand curve? It's not actually infinite, or maybe it is, but I think that the demand curve for AI compute, we think, extends out beyond any reasonable horizon, but that's yet to be proven. And so those are questions that even people approaching it from the kind of they can deploy capital really well will wrestle with, is what is kind of that return look like? One of their off ramps is I think they can take their AI compute and sell it to other people rather than using it all internally if XAI is not monetizing as well. And then you have an infrastructure as a service business, which are great businesses, and you have one that can continue to scale. And then the other question I'd say will remain unresolved, which is how much demand for compute is there out there? Right now, we're clearly compute constrained, and people will always say, but we're about to be in surplus. That's what they're doing to NVIDIA's like year 3 and 4 growth rates. That's what they are projecting the end of the cycle beyond whatever the management forecast is. And I think we'll exist in that land until we're actually at the end of the cycle.
Well, but I think an interesting point we brought up in Brainstorm is you can have infinite, quasi-infinite demand, and that doesn't mean that there's not convexity in the cycle still, right? It's like there could be 1,000, a million X more demand than there is now, but all you need is like one blip of funding or doubt that slows the process. And then, you get the convexity going in the opposite direction where timelines get pushed out because people aren't willing to invest. And then it's like, well, the next model is not going to come out, which is going to unlock even more demand. And so people think it's all going terribly until you turn the corner. And then, 15 years later, you look back and you're like, yeah, see, it's infinite.
Yeah, I think there will be wobbles
Quickly
along
with
the way.
our remaining few minutes here. Another big raise, another massive company with a lot of questions surrounding it. OpenAI, $122 billion, significantly more than 75 billion. Why do you even need to go to the public markets to raise 75 when you can get 122 from the private markets? I'm sure Elon is kicking himself saying, why did I even start this process? I could have just raised same amount in the private markets, not had to deal with all of this. Brett, your thoughts on the OpenAI raise 122, break it down. And then I think we need to address all of the news that seemed to have coincidentally hit just after the announcement of the raise itself around OpenAI, some of the drama behind the scenes, reshuffling of management. There's so much to discuss.
I think the bigger the company, the
8 minutes.
more noise there is about the executive team. I think you can think of XAI, OpenAI, Gemini, and Anthropic all as competing for I think of it as a $15 to $20 trillion kind of foundation model pie on an enterprise value basis that they're going after, just selling AI software into enterprises. And so that's on the basis of by 2030, our mid case is there will be $7 trillion in AI software spend, where businesses are paying for the productive value of the AI at a big discount to the actual productivity it's delivering. That $7 trillion doesn't all go to OpenAI or XAI or that collection of companies. It flows into there's still going to be specific AI software products that sit at the top of the stack, and they pay some of their cost basis to foundation model providers and platform as a service providers like Palantir. But in the revenue waterfall, it suggests that there's around $2 trillion that accrues to these foundation model companies like OpenAI. And so $2 trillion at kind of our margin structure that we think they're going to hit, and a reasonable multiple they could get suggests $15-ish trillion in enterprise value for foundation model providers. But it depends on what multiple people pay. So you can say 15 to 20. So OpenAI at $800 billion going after a $20 trillion opportunity, but they don't have it's not certain that they're going to get it. It's a competitive field, but even if it gets chopped into three pieces, then that's 7 trillion. So you can get a reasonable return on the top-down basis, and you can look at their specific, at least as publicly reported, kind of management expectations for revenue, which we think is achievable given the rate of growth they're going, and it's in the order of 200 plus billion. Again, look at public reporting from the Journal and elsewhere in revenue that they're expected to get. I think 250 is what the Journal reported. So 250 billion in revenue, and growing very quickly. It's not that unreasonable to think of that as being a potentially $2.5 trillion company. Again, contingent on margin structure and people's expectations for the business. So on the enterprise side, I think it's a really well-positioned company that is growing quite quickly and is changing the way that enterprise workers work. And I think Anthropic is a real deal competitor, as is xAI, as is Gemini. And I think it's not a winner take all. It's like infrastructure as a service, where you're going to have like a handful of competitors that can all generate cash flows that can all be very valuable. It's just infrastructure as a service, where infrastructure as a service is now in a hundreds of billions of dollar market. We think this is going to be a trillions of dollar market, providing these AI models to enterprise. Then on the consumer side, and Nick, I'll defer to you here, but OpenAI has on the order of 900 million weekly actives, growing quite rapidly. The entire space is probably heading into the 4 or 5 billion weekly actives in the 2030-ish time frame. So you have and the entire space we think is a little more than 1 billion weekly actives today. Actually maybe 1.1, 1.2, I think. So a 4x tailwind on that basis, plus people are going to use these things more. So there's, unexploited opportunities in monetizing that via advertising and kind of purchasing agent type behavior. Nick, which do you think will hit first?
On the advertising or agent side? Yeah, I think well,
Yeah.
it seems
Both before
before
quantum.
quantum. It's kind of interesting. They're doing this in parallel, right? You have the advertising business growing. It's at 100 million in ARR, which is not a standard term to use in advertising world because it suggests not that much of actual spend in the last few weeks since the program has been up. I think it's like $8 or $10 million, however you want to slice it. But I think that is a real opportunity. We think that that's probably a 600 to $700 billion opportunity by 2030 if you look at the global advertising market and then assume AI as a percent of advertising. And our definition of AI advertising is using it within tools. So we would already be counting some of what is flowing through Meta as this, everything that OpenAI is doing. And then on the agentic commerce side, I think that one is proving to be a bit more difficult, especially if you look at what's happened with OpenAI. Not that it's wrong, and not that I think it's going to fail. I just think they're showing that they can use, or people are using agents to discover, but people are not ready to use OpenAI as a full service checkout solution. And that's partly because maybe the product wasn't built correctly. Do I think they get there? Yes, absolutely. If you have 900 million weekly actives, you can command a huge amount of total revenue. We think that by 2030, globally, around $9 trillion will flow through agents. So being part of the facilitation of sales online, we think it'll be around 25% of global commerce and global online sales. So we definitely think these are very real opportunities. But as you've pointed out on the enterprise space, it's not a open field by any means. There's definitely competitors. I think Meta is probably a dark horse here. We still don't know what Apple's doing. I know you're going to laugh at me, but I still hold faith that eventually, once they use Google's models, they'll put out something pretty meaningful. I see. I knew it. I knew it. I can predict the future. I know when Brett's going to giggle and write me off. And then I think Gemini is like probably the realest competition they have on the consumer side. Just again, because, and we've talked about it on the show, because they can just continue to subsidize this long into the future and put real pricing pressure on anyone who wants to monetize.
See, I'm less concerned about the subsidization side and more that Google has both the wherewithal and the capability
Yeah.
to more directly
Yeah.
integrate everything it's doing with the other consumer pieces they have. I think Apple, this is the case for Apple, is Apple has all this consumer data, and so then therefore they should be able to seamlessly match these bottles up to the data. But I think you can look at how Microsoft has kind of fumbled the ball on the enterprise copilot thing and say, well, Apple's clearly following actually a worse playbook than Microsoft is. So there's no reason to believe that Apple can like put together the pieces in a way that's compelling for consumers here. But I think that Google, yes, they have cash flow, but they also, they can advertise, like within Gmail, they're actively trying to push me into using Gemini, and within Google Drive and Google Sheets and kind of all the stuff that they do on the consumer side, they can not just push people to use it, but like seamlessly integrate the consumer experience in a way that Apple's does not seem to be able to do or seem to realize that they need to do. And
I know. It's a shame. All the tech is there.
It is.
Just have some patience, please. It's only been a few years.
Give me AirPods with a camera that remember everything
You will
and
have
answer
it.
all the
You will have
questions.
it.
Okay, time here has come and gone, but we got a series of questions regarding Uber and all of their recent announcements with respect to autonomous, and then positioning themselves as the autonomous platform. Brett, do you think Uber is going to be the autonomous platform, or are they going to be wiped out?
Well, they've signed like 25 different partnerships, so they're clearly going spaghetti at the wall strategy of kind of 25 is an approximate number. I don't know the actual number of partnerships, but it's a lot. And if you cannot put autonomous vehicles into the hands of consumers such that they can be low utilization flex into the network, Uber has a very important role to play. In that it's like Waymo, part of Waymo's issue is they either have to massively over provision the network to meet peak demand, or I can't rely on Waymo because when it's peak demand, one's not going to be available for like 25 minutes. So their inability to motivate in additional supply with a price signal means that they are doomed to be an incomplete service. And I suspect, though it's not proven, that people will default to the complete service and use the other one as like a secondary, I'm going to check if this is available. And so that's why Waymo's had to sign deals with Uber in, I think, Atlanta, is because then the consumer can go and be like, well, I'm getting a ride, and then Uber will flex in Waymo if it's convenient for them, but no matter what, there will be a ride available. So the only credible alternative to that is Tesla's strategy, which is you have consumer-owned vehicles that are out there where I drive around in my FSD car, and it drives me around. And so it's like I get chauffeured around. And then at some point in the future, they'll be able to like flash up on my phone, hey, do you want your vehicle to run out and do $300 worth of work for you right now? And you'll say, yes, I'll take $300, thank you. And then that'll solve the incomplete network problem.
I agree. And what you just described, isn't it solvable though? So it's like, okay, let's say you've got Waymo fleet of cars. It's like, why not then let an individual pay to use that car for their own time? It's like you want to.
Yes.
It's like,
yes. Waymo could sell in cars. Yes, and maybe that's the partnership that Waymo needs to sign with a manufacturing partner, or Wave, or one of these others, is to actually sell in cars to like create a more complete network. But they are not yet doing that, and they have such scarce supply that it's hard for them to effectively infill any area just for ride-hail demand. By ride-hail demand, I mean demand at like the $3 a mile price point that's roughly where people sit. We think the size of the market, it goes up by, and really more than an order of magnitude as you go from $3 to $1 per mile. And so then, you need actual real supply here. So I think Uber's strategy is a good one, so long as the market remains supply constrained and at that $3 price point. And then it fails catastrophically when it gets to $1.
Love it. All right. We'll see everyone next week, and hopefully the astronauts make it home safely before then.
ARK Investment Management LLC is an SEC registered investment advisor. ARK, Wolf Financial, and Public are separate, unaffiliated entities and do not have a relationship with respect to any company marketing or selling the products or services of the others. ARK, Wolf Financial, and Public make no representation or warranties regarding and expressly disclaim any responsibility or liability for any acts, omissions, losses, or damages of the other entities or their affiliates, officers, employees, or agents. No company shall be liable for any indirect, incidental, consequential, or special damages arising out of or in connection with this podcast or its contents. The information provided in this show is for informational purposes only and should not be used as the basis for any investment decision and is subject to change without notice. It does not constitute either explicitly or implicitly any provision of services or products by ARK, and investors should determine for themselves whether a particular investment management service is suitable for their investment needs. All statements made regarding companies or securities are strictly beliefs and points of view held by ARK and/or show guests and are not endorsements by ARK of any company or security or recommendations by ARK to buy, sell, or hold any security. Historical results are not indications of future results. Certain of the statements contained in this show may be statements of future expectations and other forward-looking statements that are based on ARK's current views and assumptions and involve known and unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statement. ARK assumes no obligation to update any forward-looking information. ARK and its clients, as well as its related persons, may, but do not necessarily, have financial interests in securities or issuers that are discussed. Certain information was obtained from sources that ARK believes to be reliable. However, ARK does not guarantee the accuracy or completeness of any information obtained from any third party.